Sam was staring at a spreadsheet at 1:46 in the morning, and he couldn't make the numbers feel real. The model said the trade was safe, the market said the trade was fine, and yet his stomach was doing that quiet thing it does right before trouble. Because here's the terrifying truth. A system can be perfectly logical and still blow up your life. This is When Genius Failed by Roger Lowenstein, and it's the true story of long-term capital management, a hedge fund built by elite traders and world-famous economists. That came close to cracking the entire financial system. You're going to learn how brilliant people got seduced by leverage, why small risks can stack into a fatal one, how panic spreads through banks like a virus, and what real risk management looks like when the math stops behaving. This covers every major chapter, so by the end, you'll have the full picture. Sam didn't start this story trying to become a hedge fund legend and keep losing, even while the world watched. And the story starts with a man who was famous for being calm in chaos, John Meriwether. Meriwether was a bond trader who built a reputation for something rare. He looked at markets like a chessboard. While everyone else chased headlines, he hunted tiny pricing gaps that shouldn't exist. His specialty was a kind of trading that feels boring when it works and feels supernatural when it doesn't. He bet on convergence. Convergence is when two similar things drift apart in price and you bet they will come back together. It's like seeing two runners on the same track. One stumbles, the other keeps pace. And you assume the stumble is temporary. You don't need the runner to win. You just need the gap to close. That idea made Meriwether and his team look like wizards at Salomon Brothers. They were called the Arbitrage Group, but what they really sold was confidence. They made money when other people were nervous. They made money in small, steady bites. They made money so consistently that the rest of the firm started believing the profits were inevitable. Now, pause right there, because this is where the first trap appears. When something works for a long time, your brain stops treating it like a strategy and starts treating it like the laws of physics. Sam learned that the hard way in his own tiny version of this story. He was working at a mid-sized investment shop, and he built a simple model to buy dips in one sector and sell a related index. It worked for 8 straight months. He didn't feel lucky anymore. He felt right. He started checking the model less. He started taking bigger size. He started thinking, this is just what I do now. Then one ugly week hit, correlations broke, and his safe hedge stopped hedging. Sam didn't lose everything, but he learned something that felt humiliating. He had confused a calm ocean for a world without storms. Meriwether's world had storms too. Salomon got hit by a scandal involving treasury auctions, and the firm's culture changed overnight. Meriwether, despite his legend, eventually left because the people who had been printing money wanted a new kingdom. So they built one. Long-term capital management was founded in the early 1990s with a simple pitch that sounded irresistible. Elite traders using sophisticated models to harvest small, consistent mispricings with low risk. And investors lined up. Here's the part that makes your skin crawl if you think about it. They weren't just selling returns. They were selling the idea that uncertainty had been tamed. The fund's early years were a marketing dream. The performance was strong. The language was confident. The operation felt exclusive. The clients were not regular people. They were institutions and wealthy investors who wanted access to genius. Think of it like a nightclub with no sign out front. The door is unmarked, the line is short, the bouncer is picky. The exclusivity becomes part of the product. People don't just want the music, they want the status of being inside. LTCM became that club. They also stacked the room with credibility. Two of the biggest names in financial economics, Myron Scholes and Robert Merton, became associated with the firm. Their work helped shape how options and risk were discussed across Wall Street. Then they won the Nobel Prize. Now imagine what that does to a lender's brain. If you are a bank deciding whether to lend money to a hedge fund, and the hedge fund has famous traders plus Nobel Prize winners, you stop asking normal questions. You start assuming their risk is different. A Nobel Prize didn't change the trades, but it changed the social physics around the trades. And that social physics is how leverage gets fed. Here's where it gets interesting. LTCM's core trades were often about tiny differences. A slightly cheaper bond here, a slightly richer bond there. a swap spread that looked too wide, a government bond that should behave like another government bond. These are not the kind of trades that make you rich quickly with small money if you can borrow enough. So they borrowed. They borrowed from banks, from dealers, and through derivatives that acted like borrowing. They turned small edges into big profits by multiplying the size. At points, their leverage became extreme, with positions that could dwarf their capital. And that's the quiet monster in this book. Leverage does not feel like risk when markets are calm. Leverage feels like efficiency. It's like driving downhill with a tailwind. You start believing you found a better engine, and gravity can flip on you the moment the road changes. Sam had a friend who got caught in a consumer version of this. The friend got a credit line increase, then another, then another. He started using the credit like it was income. Everything looked fine until one job hiccup hit. The monthly payments didn't shrink when the paycheck did. That's leverage. It's not evil, it's just unforgiving. LTCM's leverage was not credit cards, it was bank funding and derivatives. But the emotional effect was the same. The more they borrowed, the more they needed calm conditions to stay calm. Chapter 3, On the Run, captures the feeling of speed. On the run, bonds are the most recently issued, most liquid government bonds. LTCM played games around liquidity and pricing differences, expecting normal relationships to hold. And most of the time they did. The biggest danger is not being wrong about the long-term value. The biggest danger is being forced to admit you're right too late, because leverage introduces time as an enemy. If you are unlevered, you can wait. If you are levered, you can be right and still die. That's why Chapter 4, Dear Investors, matters. As volatility increased and the fund faced pressure, communication became part of survival. Investors want clarity when they are scared. The fund wanted patience. Those are not the same thing. Imagine you're holding a rubber band stretched tight between two hands. One hand is the market, the other hand is your investors and lenders. When stress increases, the rubber band stretches. If it snaps, it doesn't snap gently. It snaps fast. Now the next chapter is basically a tug of war between LTCM and the people funding it. Banks loved lending to them when the profits looked steady. Banks hated it when the positions looked too big. Banks also hated the idea of being the first to pull funding because pulling funding could cause the collapse they feared. That's the weird paradox of financial panic. But nobody wants to be the one to cause the stampede. Sam ran into a smaller version of this at work during a risky quarter. The team had a position that was slightly underwater. Nothing catastrophic, just uncomfortable. The boss asked, "Are we fine?" The trader said, "Yes, as long as liquidity stays normal." The risk manager said, "Liquidity stops being normal when everybody needs it at the same time." Nobody liked that answer. It sounded like pessimism. It was actually realism. And this is where Chapter 7 arrives with a cruel title, Bank of Volatility. LTCM didn't just bet on convergence. In multiple ways, they were short volatility. They benefited when markets stayed orderly, when spreads stayed predictable, when correlation stayed friendly. In calm periods, this looks like printing money. Short volatility is like selling umbrellas on sunny days. You collect a small premium every day. People tell you you're a genius because it keeps working. And suddenly everyone wants an umbrella at the exact same time. And your obligations explode. That is the heart of this story. So what storm hit? 1998 delivered multiple shocks, but the one that punched the system in the throat was Russia. Russia defaulted on its debt and devalued its currency in August of 1998. Markets that had been comfortably pricing normal risk suddenly repriced fear. Investors fled to safety. Spreads widened. Liquidity vanished in the places LTCM needed it most. The trades that should converge diverged harder. That is a nightmare sentence in the LTCM universe. When LTCM lost money, it didn't just lose money. It lost the confidence that kept funding cheap. It triggered margin calls. It forced them to sell positions. And the forced selling pushed prices further against them, which triggered more margin calls. That feedback loop is what turns a loss into a collapse. And if you've ever wondered why Wall Street talks about liquidity like it's oxygen, this is why. You can survive being wrong if you can breathe. You cannot survive suffocation. Here's the crazy part. Even as LTCM suffered, the models and the minds inside the firm still believed the trades were rational. In a long-term sense, they might have been. But the market doesn't care about your long-term sense if you are running out of time. Chapter 8. The fall is not just about numbers dropping. It's about a psychological unraveling. People who were used to control started acting like human beings under threat. They started bargaining with reality. They started hoping volatility would calm down tomorrow. They started believing that one small rebound would buy them breathing room. Sam recognized this pattern when he looked back at his own decisions. When his model started failing, he didn't stop. He negotiated. He told himself, one more day, one more week, it'll mean revert. He wasn't stupid. He was in the grip of an identity, and he had built his self-image on being the person whose system works, multiplied by prestige, because admitting the risk would mean admitting the foundation was flawed. And when you are a firm built on genius, admitting flaws feels like betrayal. Now, Chapter 9 is called The Human Factor, and it's where the book stops being just a financial thriller and becomes a warning about people. The collapse was not only about Russia, it was about the way the partners saw themselves. It was about overconfidence shaped by years of winning. It was about a culture where brilliance could overpower humility. It was about groupthink that hides behind math. A model is not a prophecy. A model is a flashlight. It helps you see a slice of the room. It does not guarantee the room has no monsters. And when LTCM's positions got massive, even small errors and assumptions became fatal. Correlations that used to be stable became unstable. Liquidity that used to be available became unavailable. Volatility that used to be a wiggle became a wave. Think of it like building a bridge that can hold a heavy truck. If you build it with a safety margin, it handles surprises. If you build it to the exact limit, it looks elegant. Right up until the day wind, rain, and a slightly heavier load arrive together. Now we arrive at Chapter 10, at the Fed, and this is where the story turns into a system story. LTCM was not a normal hedge fund that could quietly fail. It had tentacles. It had thousands of derivative contracts with major banks. If it defaulted in a chaotic way, it could force banks to dump assets, scramble for collateral, and pull credit from the system. That chain reaction could have spread stress everywhere. So the Federal Reserve Bank of New York stepped in to organize a private sector rescue. Not a taxpayer bailout in the classic sense, but a coordinated effort where major banks injected capital and took control to stabilize the unwind. Here's what that moment teaches. Risk is not only what happens inside your portfolio. Risk is what happens when your portfolio is connected to everyone else's portfolio. Systemic risk is when your failure becomes someone else's emergency. Sam once heard a phrase that stuck with him. If you owe the bank $1,000, it's your problem. If you owe the bank $100 million, it's the bank's problem. LTCM had moved into the zone where the system could not ignore it, so the rescue happened. The positions were managed down. You heard the immediate panic was contained, at least on the surface. But the epilogue is the part that actually matters, because it asks the question you should be asking right now. What does this mean for you? Because you probably don't run a hedge fund with Nobel Prize winners. You probably don't borrow billions from Wall Street banks. You probably aren't sitting in a room with the Fed trying to keep markets from seizing up. The same failure pattern shows up in normal life all the time. Sam realized this after he finished the book. He wasn't trying to become Merriweather. He was trying to stop becoming a smaller version of the same mistake, so he ran an experiment. He took a month and wrote down every time he felt certain. Not optimistic, not hopeful, certain. Certain that a trade had to bounce. Certain that a strategy always works. Certain that a risk can't happen. Then he forced himself to add one sentence after each certainty. What would have to be true for this to fail? At first it felt like negativity. Then it felt like protection. He started seeing how often his confidence was based on the recent past, not the full range of reality. Because When Genius Failed is ultimately a book about humility. Not fake humility, like saying anything can happen, while still betting like nothing can happen. Real humility, like building your decisions to survive surprise. Now pay attention to this because it connects everything we covered so far. LTCM wasn't destroyed by ignorance. It was destroyed by precision without resilience. They were precise about small pricing relationships. They were less resilient to regime changes. They assumed the world would keep behaving like the world they measured. And when the world changed, the leverage turned that change into a blade. That's why the title hits so hard. It wasn't that genius didn't exist. Genius was real. The failure was thinking genius could replace structural safety. So what are the big lessons, chapter by chapter, was in plain language? From Merriweather, you learn that skill can be real and still become a trap if it turns into identity. Skill should make you cautious, not arrogant. The better you are, the more you should respect tail risk, the rare events that rewrite everything. From hedge fund, you learn that success attracts capital, and capital changes behavior. When you get bigger, the game changes. The same trade that works at small scale can break at large scale. From On the Run, you learn liquidity matters more than value when fear shows up. In panic, people don't sell what they should sell. They sell what they can sell. From Dear Investors, you learn trust is fragile. Performance builds trust slowly. Uncertainty destroys it quickly. Communication can help, but it can't undo structure. From Tug of War, you learn lenders and counterparties are part of your risk. Your funding is not permanent. Your ability to roll positions is not guaranteed. Your survival depends on other people staying calm. From a Nobel Prize, you learn authority can blind the room. Credentials are not immunity. In fact, credentials can become a sedative that puts everyone to sleep right before the fire starts. From Bank of Volatility, you learn that steady profits can hide explosive exposure. If your strategy makes money when nothing happens, ask what happens when something does happen. From The Fall, you learn feedback loops are real. Losses create pressure. Pressure creates forced selling. Forced selling creates more losses. You have to design to avoid the spiral. From The Human Factor, you learn emotions don't disappear because you have a model. I'm stressed doesn't care how smart you are. It finds the weakest assumption and pulls. From At the Fed, you learn interconnectedness is a weapon and a vulnerability. Systems fail through connections. Stability requires coordination when panic threatens to spread. And from the epilogue, you learn the biggest threat is thinking you are the exception. Now stay with me because this next part is where you turn the story into action. Here are 4 things you can start doing right now based on what we just covered, and none of them require you to be a hedge fund genius. First, start measuring your leverage in real life. Leverage is not only borrowed money, leverage is any obligation that grows when your margin for error shrinks. A huge car payment, a fragile job with no savings, a trading account with position sizes you can't emotionally handle, or even a schedule with no slack. Write down the commitments that would become painful if your income dropped or your portfolio dipped. Then reduce just one. One smaller obligation can change how you think under stress, and thinking clearly is half the battle. Second, build a personal liquidity buffer that you refuse to touch for ego reasons. Liquidity is your ability to wait. Waiting is your superpower. If you invest, keep cash for emergencies. If you trade, keep cash to avoid margin pressure. If you run a business, keep cash to survive a slow month. A buffer is not wasted. A buffer is oxygen. The goal is not to maximize returns in perfect conditions. The goal is to avoid being forced into bad decisions when conditions are ugly. Third, stop trusting any strategy that looks smooth without asking what it is short. If something produces steady gains, ask what risk it is quietly absorbing. It might be liquidity risk, volatility risk, or correlation risk. You don't need to be technical. You just need to ask one honest question. What kind of day would break this? If you can't answer that, you don't understand the strategy yet. And if you can answer it, you can decide whether you can survive that day. Fourth, add one simple humility ritual to your decision process. Sam's version was writing down certainties and then challenging them. Yours could be smaller. Before a big decision, ask, what would change my mind? If the answer is nothing, that is a red flag. Another ritual is to imagine you are explaining your decision to someone who will bet against you. If you can't explain your downside clearly, you are probably ignoring it. Humility isn't self-doubt. Humility is risk awareness with a spine. If you only remember one thing from this entire story, make it this. Being smart is not enough. You have to be survivable, because markets will always produce moments where the math feels useless, the crowd feels irrational, And the only thing that matters is whether you built your life to handle surprise. That's it for this video. I hope it was useful and gave you something real to think about. Thanks for watching, and have a great day.